Hello everyone, hello guys, welcome to my class. And have you interested that what auditor must do if something will happen after financial statement reporting period was done? If some changes happen, what manager should do or auditor should change their report or not? So today we are going to consider these questions and let's start. Now I'm going to share the screen. So today's our topic is chapter 18, audit review and finalization. So first of all, my topic here, I will explain you subsequent events and other topics will be explained by other students. So here, first of all, let's read the definition. What are the subsequent events? What does it mean? So subsequent events are events occurring between the date of the financial statements and the date of the auditor's report, and facts that become known to the auditor after the date of the auditor's report. So at first sight, maybe you are confused. What are the subsequent events? Let's explain this by the line which I drawn for you. So here. We know that for many companies, fiscal year begins in January 1st and ends with December 31. So in this period here, in this period, everything what happened in the company must be reported on the financial statement. Yes, so because of this, it's called reporting period. But after here, December 31 is a balance sheet date, or we can call it like cutoff date, because after with this date, December 31, financial statement will be how to say closed. So as like after this date, new financial statement will be done. For example, from January 1st to December 31, the financial statement will be done for 2020, but after December 31 will be done financial statement for 2021, like this. So in the definition, we have told that subsequent events are events occurring between the date of the financial statement and the date of the auditor's report. So here, the date of the financial statement is balance sheet date here, this date, and the audit report date. It means this range. Now I will show you like this. This range here, the first this range is in the definition, it's the first range from financial statement date. It means from balance sheet date and the two auditor report date. So the next one is here, and the facts that become known to the auditor after the date of the auditor's report. It means here, after the auditor report date, the changes, the facts. So this whole range will be called subsequent events. If it's still not understandable, let's hear. So it's the first day beginning, it's the ending of the fiscal year, it's here our reporting period, and here it's accounting report date. After this date, so after balance sheet date, uh, uh, the financial statement will not be issued. It must take some weeks or months, like this. So here, what the situations can happen, like prepare adjusting entities, counting inventories, like this, and ensure accounts records are complete or not, like transactions like these transactions can happen at this period. And here, accounter will report its report, his or her report, and But after accounting report signed, before financial statement issued, there can happen another event, and call this event here, we call them subsequent events. So I very hope that it was understandable for you. Then let's how to say, so let's continue. And here, but our subsequent events uh, will be divided for two categories: adjusting events and the non-adjusting events. Here, adjusting events, in the book, it may be complicated or not understandable. I try to explain with simple words. Adjusting events, it's when the condition exists before cutoff date. Mm, before this date, adjusting events will be if the condition exists before cutoff date. For example, technological change find out, for example, at uh, now, maybe at March, technological change find out, yes. And it will affect our inventory. So maybe the price value of inventory will be mm, lower than before. But if this technological change happened before the cutoff date, before the balance sheet date, then it means it will be adjusting event. That here, look at me. Here, um, technological change happened. For example, I told that it happened in March, yes, here, but uh, but we only realized that this technological change happened. We only realized that the technological change here, but this actual technological change maybe happened in, for example, November 12th, yes, because this condition happened before the balance sheet date, and we just realized that we just find evidence to this technological change only after the balance sheet date. Because of this, it will be adjusting. And it will be adjusting event, and we in adjusting event, as the name tells us, we must adjust financial statement according to this event. For example, if we return to our example, technological change find out, it means that measurement of inventory must be adjustment, and the updated value of inventory must be reported in the financial statement. So let's give another example. For example, customer declares its bankruptcy. So how do you think it will be, adjusting event or non-adjusting event? So you cannot answer still, because we don't pass the non-adjusting event. So here it will be adjusting event, because, for example, let's again here, customer declares its the bankruptcy. It was bankrupt bankrupted. So but it will be adjusting even, because how to say, financial financial condition of this customer was bad before this balance sheet date. We just realized, we just find evidence to this bankruptcy after the balance sheet date. But due to the reason that this bankruptcy actually happened before the balance sheet date, so it will be adjusting even, and we need to um, change allowance for doubtful accounts and the financial statement. The changes will be done in the financial statement here by management. And so um, let's move further. Yeah, I think the adjusting event was understandable. As it says, adjusting event must it this condition, this event must be happen before the balance sheet date or cutoff date, and the change will be made in the financial statement. So financial statement must be adjusted due to this adjusting event. So the second type is non-adjusting event. In non-adjusting event, the condition exists after cutoff date. For example, here, um, let's, for example, here, oh no, here that the fire was happened and some assets was damaged, some assets were damaged, and what will happen in this situation? What will happen? So since in this damage happened after balance sheet date, it will not affect to the to this reporting period, and it will not change financial statement, and there is no need for adjusting and then making change in the financial statement. Another example, if the company purchase another business, what happens at this situation? If the company purchased another business, but they purchase its business here after the balance sheet date, then again it will not affect to the previous year's reporting period. So there is no need for adjusting financial statement here. So we are telling that a condition exists after cut-off date. And our evidence was available in subsequent event period. Here, so to understand, could I explain you or not? Let's ask some questions. Here, let's assume that fraud or error showing the accounts are incorrect. It will be adjusting event or non-adjusting event. Pause the video and you can answer, and then continue the video. So the answer will be adjusting event, because fraud or error showing the accounts are incorrect. This fraud or error happened in the reporting period. This error happened here, not after the balance sheet date. Because of this, it must be changed in the financial statement, and it will be adjusting event. The next question, announcement of a major restructuring. There was announcement of a major restructuring. How do you think? Will it be adjusting event or non-adjusting event? So the answer will be it's non-adjusting event, because here announcement of a major restructuring was made after the balance sheet date, because it was made after the balance sheet date, and we can say that it's a non-adjusting event, and no need for making changes in financial statement according to this announcement. But it doesn't mean that we mustn't consider this non-adjusting event. They must be done at least this disclosure in financial statements that as a name subsequent event or full disclosures are required. So here now we will continue with audit procedures to test subsequent events. So audit team should perform procedures to gain sufficient appropriate audit evidence that to test their any subsequent event. There must be adjustment, must be made adjustment or disclosures in financial statement or not. So what kind of procedures can be made? This ISA 560 lists some of these procedures, and the first is inquiries of management. We know that inquiry of management, we are asking from the management, give us some information. Inquire means like this. So, for example, whether there are any new commitment, there are new borrowings or guarantees like this, and or sales of assets were down, or destruction or fire of assets happened like this, or new debt issued, or new shares issued. Um, Maybe here unusual accounting adjustment or major events. Even going concern problems can happen after the financial statement date, before a balance sheet date, and before audit report date. So we must management, we inquire of management to give us such kind of information, and get appropriate sufficient audit evidence that there exists subsequent event or not. So, and here other procedures. Other procedures. So, auditor not only can inquire management, not only can ask management, and auditor or audit team can review management procedures for identifying subsequent events to ensure that such events are identified, or minutes of general board, like read their report that inquire about unusual items, there were unusual item or not, or review lists available in interim financial statement, obtain evidence or obtain written representation. Here, written representation will be explained further in this chapter, and don't worry if you don't know what is written representation. So let's move. Now we have discussed that the subsequent events, and the procedures for testing subsequent event before audit report date. Yes. And now here we will discuss about facts discovered after the date of the auditor's report, but before the financial statements are issued. If you can see here, after the date of accounts report date, it's here. After the date of auditor's report, but before the financial statements are issued. So actually, we know that the financial statements are the management's responsibility, and management must inform the auditor if there is some changes, some even subsequent events happens between the auditor's report date and the financial statements issued date. So here auditor doesn't have any obligation to make changes in his or her report after the audit report date, but also auditor can do this kind of procedures if there is a subsequent event after the date of the audit report, but before the financial statement are issued. So first, discuss the matter with management and those charges with governance. For example, happened again, for example, fire, yes, and this fire even subsequent even must be discussed with management, and those people, these persons with who charges with governance. And secondly, determine whether the financial statements need amendment. Here, amendment means like change, need change or not, like this. certainly, if amendment is required, if change is required, then auditor must inquire how management intends to address the matter in the financial statement. It means if there is any change is required, then we should know, we should ask from management that how they are going to deal with this matter and in the financial statement. So the next, uh, if amendment is required, if there is a change is required to the financial statement, and the management makes the necessary changes, like management, if management make these changes, then auditor must carry out this number of procedures. First, undertake any necessary audit procedures on change made. uh, if there is any necessary audit procedure, then auditor must carry out this procedure. Then, secondly, extend audit procedures for identifying subsequent events that may require adjustment of or disclose in the financial statements to the date of the new auditor's report. Mm, it means like they extend like auditor should make any other audit procedures to identify the subsequent event uh, that may require adjustment or any disclosure in the financial statement to the date of the new auditor's report. New auditor's report will be done before the financial statement were issued. So certainly provide a new auditor's report on the amended financial statement. So there is in this situation, in our situation, the amendment was required, and the new financial amended to this the financial statement which made changes was done, and the auditor must report new auditor report. So, for example, if if uh, customer was bankrupted, yes, customer bankruptcy was done, but or like uh, fraud or error was done, but it was available after the audit report date, and this fraud or error must be changed, yes, in the financial statement, and it means that this fraud or error need amendment, and amendment need change, and change is required to be done in the financial statement. So audit, in our case, in our example, audit will first, if there is any necessary procedure, then audit will undertake it. Then auditor will extend its audit procedures to identify subsequent event. Certainly, new auditor report will be done according to the changed, amended financial statement. So here in the previous case, the amendment was required, and the management did amendment. Management did change, but here, if management doesn't amend the financial statement, if management doesn't change the financial statement, in this case, what auditor must do? What auditor should do? First, if the audit report hasn't yet been provided to the entity, if the audit report hasn't provided to the shareholders, like as a persons, and the auditor shall modify the opinion and then provide the auditor's report. Here, modified opinion, we know that it's like qualified opinion, but here auditor suggests future procedures to avoid the misstatement in the financial statement. So here auditor should modify the opinion and then provide the auditor report. But in the second situation, if the audit report has already been provided to the entity, already been provided to the shareholders, what will then be in this case? So here, auditor first, auditor shall notify the management and the discharge with governance. Auditor should notify management and the other shareholders not to issue this financial statement before the amendment was done. Um, and but all if already the financial statement were issued, then if the financial statement were issued anyway, that auditor notified them that it mustn't be issued because there must be done any change, but still the financial statement were issued, then auditor shall take action to seek to prevent reliance on the auditor's report. It means that then auditor should should take an action that his or her audit report isn't reliable. To notify this message, they should take action. Here the next situation, facts discovered after the financial statement have been issued. Here the financial statement have been issued, and here is the last step. Our last step, it be done. Financial statement were issued, and in this case, what the auditor should do? Again, auditor shouldn't take auditor. Doesn't have any obligation to do anything, but in any way, like previous cases, discuss with the management and with charged with the governance people about this matter. About secondly, determine whether the financial statement needs amendment, needs this change, or there is no need for change. Thirdly, if there is a change, if there is it needs a change, then how management intends to address the matter in the financial statement. Here, for example, if, for example, again, new something happened to the building of the company, and if this matter, this case will be discussed with management firstly. Secondly, if of course this because of the uh, because of the matter with building, it must be done change in financial statement if this matter, this case was happened before the financial statement date, as we discussed before. Certainly, if there is a change needed, then we ask to management how they are going to deal with this case. And also then if after this audit, if there is a required change, auditor should make new audit report, and in new audit report, explanatory paragraph will be included, and this explanatory paragraph will be discussed in chapter 19. If management doesn't take any necessary steps, if management doesn't make any amendment to the financial statement, then first auditor will should notify the management and the other people who charge with governance. If this notification wasn't useful, then if still management doesn't act, then auditor shall take appropriate action to seek to prevent reliance on the auditor's report. So auditor must inform necessary parties that the audit report isn't reliable and that the financial statement isn't reliable because management doesn't make any necessary change in financial statement. So I hope that this chapter this part was understandable for you, and if there are any questions you can contact me directly, and I try to explain in your language if my English wasn't so clear for us, for you. So thank you for attention. I will pause this.